In retirement, you're in charge of paying your own taxes. And if you don't do it the right way, the IRS can charge you more, even if you pay everything you owe. So let's walk through exactly how this actually works. We'll cover everything from tax withholding and quarterly payments to what a lot of people end up doing, which is just filling out a return in April and figuring out, oh, I guess I owe a few $1,000s, and they write a check. You see, the tricky part is not just how much you pay, but also when and how you pay it. So we're not going to look at which website and where do you click, but we're going to talk about the basics of how do you deal with your taxes in retirement. And we'll also cover a strategy you can use late in the year if you realize that you were not paying as much as you're supposed to. Unfortunately, taxes don't go away in retirement. What does change is how you pay. When you were working, your employer handled all of that for you. So they'd withhold taxes from your paycheck, send that to the IRS. Now you need to be the one who decides how much exactly should you be sending them and making it actually happen. This matters, of course, for two reasons. One is that you only get to spend what is left after taxes. And if you don't do everything correctly, the IRS might charge you penalties, and nobody wants to pay those penalties. Now, before we get into how you pay the taxes, just briefly keep in mind that your income comes from a variety of different sources in retirement. You might have pre-tax IRAs and 401ks. There might be pensions, Social Security, or the taxable part of Social Security, Roth accounts, bank account interest. And those are all taxed a little bit differently, but the question for this video is, once you know that you owe, how do you pay? Well, it's not automatic anymore, and there are two main ways you do this, whether it's withholding or estimated payments or some combination of both. And by the way, we're talking primarily about federal income tax here, so don't ignore the state taxes either. Let's start with withholding. You can generally choose a percentage for your custodian, that's whoever has your accounts, to withhold. You choose a percentage and they send that directly to the IRS. So if you had a $10,000 distribution, you withhold 20%, then 20% or $2,000 would go to the IRS. The remaining $8,000 would come into your account or come to you as a check. That's generally something you'll do with IRA or 401k withdrawals. And on the screen, there's going to be an example of what tax withholding looks like on a form, and you can choose federal or state tax withholding. Sometimes you can say, do not withhold taxes at all. Be careful because sometimes that's not an option. And then you can also enter a percentage sometimes. So tell them the percentage you want withheld. And this can get tricky because you need to pull out extra to get what you want for spending after those taxes. Otherwise, you're going to end up with less than you wanted, or that might happen. So when you withdraw extra to account for the withholding, it increases your income, and that can increase what you owe. So it's kind of this circular thing. But in some cases, you can just ask for a net amount, N-E-T, net amount, as opposed to the gross amount, and they will figure that out for you. Or you can figure out the gross yourself. And to do that, you divide the amount you want, or the net amount, by 1 minus the tax rate. So let's take an example of that. Let's say you want let's say $10,000 after taxes, and we're going to assume 22%. So we say 1 minus 0.22, that's 22%, is 0.78. So the next step would be to say 10,000, which is our desired net amount, divided by 0.78. And this will tell you that if you want 10,000 after taxes, you need a gross withdrawal of 12,820, or 821, I guess. Going through that exercise would help make it happen that you actually get the full 10,000 into your bank account, for example, and the 22% would end up going directly to the IRS. You can also withhold from Social Security and most pensions, and withholding is probably the easiest approach, easier than making those estimated payments, because you don't have to log in anywhere, you don't have to send a payment or write a check. The money just comes out of whether you're getting a payment or a distribution, and whoever it is sends it straight to the IRS. It is also advantageous because withholding is treated as if it's done throughout the year. And in a minute, you'll see why that's so important. But you might prefer to just pay from outside sources. Maybe you've got a lot of money in a bank savings account. It's just generating interest income that adds to your taxable income every year. So maybe you just prefer to write a check from there instead. And that brings us to estimated payments. The IRS says that you should pay as you go so you won't owe. Who says the IRS doesn't have a little pizzazz? With this approach, you can write a check or you can pay online. It's up to you. And there are 4 payments that you would generally make throughout the year. They don't fall on the typical quarters that you're probably used to, like April 1st, July 1st, October 1st. They're slightly different dates, so you need to figure that out. But you get those payments in, and you're effectively using 1040 ES, but you can pay online or you can print out a little voucher, send a check. Again, it's your preference. The idea here is to pay taxes for whatever income you received during that quarter. So if you're getting, the same monthly amount from a distribution or a payment every single month, then it's probably going to be the same amount of payment every quarter. But let's say you did a big Roth conversion or took a big withdrawal from a pre-tax retirement account early in the year, in February, for example. Well, in that case, you are supposed to pay the tax for that income in that quarter, in the first quarter's payment. So how do you know how much to send with each payment? Well, you have to estimate your income for the year, essentially, and then kind of figure out what's attributable to each quarter. So you might figure out, what do you think you owe? And then add this distribution or the conversion early in the year. How does that change the taxes due? And that increase is what you might pay. This is tough because you can't just go off of last year's tax return, especially if you're in your first year of retirement, and the tax laws change from time to time. So it's best to do some sort of estimate. And to do that, you might use something like the Dinky Town 1040 calculator if you don't have any tools of your own or an advisor to do this stuff for you. You would basically enter all of your income. Let's say you've got $5,000 of interest from the bank. There's $24,000 of pension income and $25,000 of Social Security. Just assuming a single person here. By the way, $10,000 of that, almost $11,000, is included in your taxable income of the Social Security. So you'd come on down and say, all right, the tax due seems to be about $1,639. But if I was to add a taxable IRA distribution, maybe you want another $40,000 for spending, or you're going to convert $40,000, then the new tax due becomes $94.58. So the difference between what it was before you had this IRA withdrawal or conversion and what it is after can help you figure out, in the ballpark, you want to verify this and triple check, but it can help you figure out how much you might owe for that quarter, again, if you did this all in February. You can see that exercise takes a couple minutes. It's not perfect, but it's probably better than just waiting until April and filling out your return and then figuring out, oops, I owe $9,000, or I owe, $7,000 or $8,000 more than I thought I was going to owe, and there's probably a penalty on that. So what's important is that the IRS doesn't want to wait until April, and the timing can really matter. So with withholding, it's treated as if it was taken throughout the year, but with estimated payments, then yes, the timing does really matter. If you want to look a little bit closer at how much to pay in and the timing and all that, then you can look at the IRS safe harbor rules. So you may be able to avoid penalties if you pay in enough during the year. And we're not going to get into the weeds on that. That's something you should look up and research carefully. Now, there is a little trick you can use if you think you haven't paid enough. Maybe it's late in the year, it's December even, and you realize you forgot to make some payments or just have not been paying enough. Well, you can potentially just take a distribution from, let's say, a pre-tax IRA and have 100% of that withheld, sent to the IRS, or some very high percentage, depending on what you're able to do. And that can potentially save you from some penalties because the IRS, again, with withholding, it's treated as done throughout the year. It's not treated as only having happened in December. So that could potentially save you. And some people even try to pair this with a 60-day rollover, put the money back in. Again, that's something you can look into on your own if you want. But think about that if you think you're facing a big penalty. So we talked about penalties and withholding and estimated taxes. Let's do a quick refresher on what actually causes you to owe taxes in retirement in the first place. I've got another video, but just to hit the highlights, different sources of money have different tax features and characteristics. When you pull money out of traditional or pre-tax accounts, like a traditional IRA, pre-tax 401k, 403b, etc., that withdrawal is generally treated as ordinary income. And as we saw before, some of your Social Security benefit can also get included in your taxable income. Then you've got brokerage accounts, like an individual or a joint brokerage account. With those, you often pay as you go. So you're getting income, maybe dividends, capital gains distributions from various investments. And then if you sell something for a gain, then you would also be realizing that gain for the year in which you sold. All of that can be treated differently if it's a long-term capital gain versus a short-term capital gain versus some interest in your account. Your pensions are typically taxable, but look into that. Bank account interest is ordinary income as well. And of course, those Roth accounts, if you meet all of the IRS requirements, are tax-free withdrawals. And here's a tip: it can be tempting to pay as little as possible in retirement when you don't need to. So in your early years, you might say, well, that's great. I don't have to really pay income tax. And so I'm, living large and enjoying myself. But you have to remember that in your 70s, your RMDs may begin and start putting you into higher income tax brackets. This could also affect how much you pay for Medicare. So instead of paying zero, this blue mountain here, by the way, is your income, let's say. Instead of paying zero in all these years when you can, it could make sense to strategically just pay taxes at rates that are relatively attractive, and that might smooth out these types of problems. So instead of having a big blue mountain show up later in life, maybe you're going to pay more steadily throughout life. That might or might not benefit you. It's just something you want to run the numbers on, whether you pay nothing for a while and then pay more later, or if you smooth things out over time. The way you would do that type of smoothing is often either through just, spending down and withdrawing from those pre-tax accounts even before you're forced to, or maybe doing some Roth conversions, moving some of that money from what's a pre-tax account to what will hopefully be a tax-free account later. And the video popping up right now will go into more detail on all of this. I hope you found that helpful. If you did, please leave a quick thumbs up, check out my website, maybe send me an email, and I look forward to talking with you soon.